today we will see the practical applications. So value at risk and expected shortfall will be on the menu. So this is chapter 12, and we can see that now we are close to the end of the 200th page, so a lot of things will happen. And again, from last week, you can remember that practically this is what matters as the relationship between returns and also the histogram or the probability distribution of the data. And at the end of the day, we are looking for the extremities. And this is where value at risk and also expected shortfall will help for us, because it will help to determine that what is the threshold for the extremities. So it will guide us, and also expected shortfall will give the picture that what happens after the threshold. So what kind of any kind of possible losses can we expect? So yeah, correlation. Okay, we can remember on this thing, but in the case of total risk in a portfolio, practically it could be a single number, because yes, total risk in a portfolio is the standard deviation of the portfolio. So nothing new is there, but can we describe the thresholds of possible total losses in a portfolio? So the easiest way is to take the value at risk. So practically we are looking for some money. How much money can we lose at a defined certainty, and that's why it means that this certainty is so practically a probability. So we have some kind of confidence level that, okay, what is the 95% of probability that we are not losing, or 99% of probability that we are not losing. So practically we are looking for 1% or 5% confidence intervals. If we are checking the legislation, mostly everybody is looking for the 1% interval. So maybe 5% will be not there, but I will talk about it later on. And also in a time horizon, but we can make this also a conditional one. So we can use a Gauge model to describe everything here, and to define if we have daily conditional standard deviations. Practically we can fit a VaR for each days, so it's not a big deal. And we need two things. So first of all, we have to have some kind of expectation about the probability distribution of the possible changes in the asset price, and that's why we can define the gains and losses. And in most of the cases, so we have the simple expectation that the standard deviation is symmetric, which is obviously not, because the skewness is never zero, so it's always positive or negative. You have to be really, really lucky. So sometimes in the case of euro, US dollar, we can see that, yeah, it's behaving like a sinus curve, but otherwise it's asymmetric in one direction. So we have much more dramatical decreases than increases. So, and also sometimes it can happen that the two sides are coming from two different distributions as well. So yeah, so that's why we have to keep it in mind. Because the book will completely say that, oh, it's symmetric and it's perfect. Yeah, and as I mentioned, that 1% probability, if it's a normal distribution, then that's simple, because to describe normal distribution or to calibrate it, we need just the expected value and the standard deviation of the data, and after that we just have to fit in the numbers. And for 1% probability, we just have to multiply the standard deviation with this 2.326 number, and for the 5%, we need just multiply it with 1.65. So it's absolutely simple, because also we can say that, yeah, but these are zeros, because expected value is 0, so this is what remains there. But on the other hand, it's quite robust. So if we have just a short amount of time to estimate the value at risk for normal distribution, even if we know that in the practice it's not that normal, still the definition of the thresholds are quite good. So in the past we had a paper where we were analyzing the Dow Jones Industrial stock market index for 100 years, and it was a daily data, and we were comparing different approaches, how can we detect extreme values, and if this is completely simple, it's quite robust. So that's why we can understand that why people have chosen this one. Just the problem is that normal distribution always underestimates tail risk. So practically much more extreme events can happen, so much more higher losses can happen in US dollars than it's estimated by the normal distribution VaR model. So yeah. And the problem, okay, it's highly a practical thing, but if the mass increases after some level, so let's go back to the initial. So we can see that the mass increases in the tails. So this is absolutely not recognized by the VaR model. So this is one kind of tail risk, but otherwise tail risk is always underestimated. That's why expected shortfall is much better, because it contains the entire tail of the data. So we are taking the same threshold like in the VaR model, but not just saying that, okay, this is the possible loss here, but everything, so the whole surface of the losses will be accounted. So VaR is just one line, and that's all. Expected shortfall is the whole thing after the line. So if things go bad, what can possibly go wrong? And practically it says that we have an infinite amount of VaRs after the designated VaR, and we just have to add them together. So it's much better because it says that it recognizes the benefits of diversification, and it's more difficult than estimating a VaR, obviously. Yeah, and after that, we have to think about that how can we design a risk measure, so an approach to deal with risk, which will have for us. So practically these are the four main key requirements where we can calibrate any kind of model for risk management. So first of all, it should be follow this monotonicity requirement. So it means that if we are taking more risk, then we should have more capital, because practically this is what we have to calibrate here. So the capital to absorb losses must be defined well. So the second thing is homogeneity. So if we are increasing the size of the portfolio, then the capital requirement should increase as well. So it should be a linear relationship between them. And translation invariance means that if amount of cash is added to the portfolio, then the risk measure should go down by k. So practically, if we start to add lower risk assets, then it should create some kind of diversification. So capital requirement should decrease. Sub-additivity means that we are taking two portfolios, two risk measures, and after that, if we are adding them together, then at the end of the day, the combined portfolio's risk measurement should be same or lower than, but not higher than the merger. So practically diversification should be useful, at least, and that's why these exponential spectral risk measures are behaving like this. So we have some quantiles, we have some kind of constant, and after that we can calibrate by following the quantiles, or in this case it says percentiles because it's 100%. But I always say quantile because we have to use the quantile function in MATLAB. So I know that in Hungarian it's always I'm corrected that it's quartilish and no, it's quantile. So yeah, good. So parameters for them. So we can say that yeah, this one is so nice and simple. So so for any kind of p quantize or sorry probabilities, we can define that. Let's just take the normal inverted normal distribution, and then with the appropriate probability, just we can calibrate the data here. For expected shortfall, we need some further homework here because yeah, the percentile point of the standard normal deviation must be defined here with this epsilon, and also we have this thing under here. So yeah, this is a bit more difficult, but still we can manage this one. And what we should see here that what is the percentile point, because right now this is not given by the equation. So we should improve this one, but we can see that yeah, it's a bit same. Also time horizon. So usually this VaR and ES models are focusing on the short time or short run time periods, but we can convert them back and forth just taking the square root of time. So this is what we can see here, that okay, day before or day later, what happens here, just taking the time. Next thing, autocorrelation. So obviously if the dataset remembers on itself or the past values, then it means that information can come back again and again, and the data will develop as a random walk, so an autoregressive process. But it means that this will plague the yeah, sorry. So it will plague the change of the price of the asset as well. So this is supposed to be the autocorrelation, and this happens. Unfortunately, sometimes under stressful periods, autocorrelation even at stock markets, stock market indices can increase to 30 days. So it's not just for 1 day, 2 days. But on the other hand, when we were running our studies, also it happened that only half of the data was, so half of the cases when it was increasing to 30 days was practically under the time period of a recession. So sometimes it's just increasing, so it's without any kind of external shocks, just I don't know what happens. But we were not able to identify any kind of special time periods when what was the reason, because we tried different approaches, but at least the recession time periods were not fitting at all. Yeah, so we can calculate this ugly thing here as well, and we can see that how autocorrelation can affect price changes, but yeah, maybe later on it will be relevant. Okay, and what is the confidence level? So practically we are looking for capital at the bank will have a probability of chance to becoming insolvent when we are losing money. So convert all value at risk and expected shortfall with one confidence level to that other confidence level. So how can we convert them? And this is how we can do this. So this is the new one, this is the old one. So again, we are using assumptions for normal distribution. but after that we can see the conversions here or for expected shortfall as well. So at least it's quite straightforward. We don't need specific approaches. So mostly what I was able to see, that time horizon conversion, this one is, I don't think so that it will appear again, but the other one, confidence level conversions, are also can be relevant. And still we have several kind of value at risk seeds. So marginal value at risk. So what happens if investment amount is changing inside the portfolio? So it says that this change in the VaR model, if we are increasing the portfolio in the one sub-portfolio, so practically we are buying more stuff in one asset, it will relate it to CAPM beta, and so if you are thinking about it, maybe yes, because in the case of the VaR model, if you are imagining it, then there are the different assets variances and also the correlations, but practically the correlation is covariance between the market portfolio and the asset. And if we are dividing it with the market portfolio's variance, then we will get the beta. So if we are doing this, that maybe it can be, but I cannot see that, okay, how the change of one asset, so if we are dividing everything with just the amount of money, how it will resemble us. Because if we are doing something at the variance covariance matrix level, then the divisions should happen also at the variance level, not just amount level. So this one is, I can understand that why it's written by the book, but just from this kind of equation I cannot see it. Incremental value at risk. So is a portfolio in the incremental is the incremental effect of the what? So difference between VaR with the sub-portfolio and the VaR without the sub-portfolio. So practically we are taking that, checking that what happens with the portfolio if we are removing some parts. Component value at risk. A small percentage change in the amount invested in the ISO portfolio and recalculating VaR. So how can we move back and forth if we are changing? But in this case, this is highly the same like marginal value at risk. So, okay. And last thing, Euler's theorem. So V is the risk measure for a portfolio and I is the measure of the size of the portfolio. When X is changed to this thing, so practically we are increasing it with some number to itself, then for an X, the V, which is the risk measure, will increase also by a magnitude of, by a multiplication of the lambda. So practically it says or suggests that if we are investing more into the stuff, then we just have to multiply up the value, the possible losses. So it will just scale up itself up. There are no additional corrections or other things, just the increase in the amount. Okay. Component VARs are therefore a convenient way to allocating total VARs to sub-portfolios. Yeah, because we can do these things. Expected shortfall can therefore be allocated to the component parts and business similarity to VAR. So practically it doesn't matter What matters here that if we have aggregations, then we should add the correlation between them. But we know that this is not stable. So this is okay. If we are running short-run models, practically the instability doesn't matter as much because we are just calibrating again and again or rerunning again and again. But yes. Yeah, and also we need backtesting. So how can we do this? So we should say that if we have some amount of data, then this sampling or procedure will be run, and we are looking for the past performance of this model. So practically how well the current procedure for calculating the measure would have worked in the past. And looking for an optimum in the loss in a day would have exceeded the 1 day 99% VaR when the later is calculated using the current procedure. Yeah, so backtesting can be useful, just it still can underestimate risk sometimes. So especially in the case of tail risk, when we know that there are really a small number of data points where we are talking about. So if there is a new crisis and put some data points here, then we can have really nice backtesting. Just mostly it's about avoiding lawsuits. It's not about mathematical issues, because in this case you can say that everything was solid from statistical point of view just after that crisis happened. And in this case lawyers cannot say anything about it because you tested backwards. And so if we would like to estimate this one, then we have to solve this disgusting thing. So we need a binomial distribution, and practically the binomial distribution part is everything here, just here we have the probability of loss. So with this Excel function we can do this, or similar thing with MATLAB. We can do this because otherwise these are the things what we have to do. So yeah, we don't want to do this. And also we can have the bunching, so daily portfolio changes are independent. See? Exceptions should be spread evenly through the period used for backtesting. If they are used, if they bunch together, then suggesting that losses on successive days are not independent. So that's why we should test it as well, because this independence, non-independence in changes, practically this is autocorrelation. If you are looking it closer. Yeah, so I showed you many things. So let's run calculations. So before we are doing any examples, just let's run our data set, and I collected some past data to see that what happens here and there. So this is just, it starts in 2020 and then ends in 2021, so this one is a bit old, but practically this is a portfolio created from two different stock market indices. So the mixture ratio, okay, yeah. So the mixture ratio is just 33%, and we are just checking the changes. So these are the prices, and after that we are just looking for the returns. So it's nothing important what is happening here. And after that, just we have to check that what is yeah, so this N2 is the portfolio value, which is 1. And after that, we just have to see that, okay, how does it change in amount of money. This is just for normalization of the issues. And I needed this one because obviously I cannot do anything with so I needed some time frame, so I needed t like data, and this is where we can see that right now we are stepping here in this time period, and we can see this is the looking backwards kind of setup. And after that, if we are saying that, okay, let's take all of these numbers and let's put them into an ascending order, or sorry, in this case, descending order, because yes, so these are the negative numbers, so this is descending one. And in this case, we can expect that the 99% will be located here. So this is the VaR level, and this is the all expected shortfall thingy. So this is the brute force solution for everything, because we are just taking this out. A more elegant would be if we would just have 100 data points, because just in this case everything would be just 1, so that's why I have to increase it to 250 days and more data points, and then we can see a bit more of them. Yeah, so these are 5 data points, which means that 1%, but and also this is the positive side, so the negative side of the VaR supposed to be 1, 2, 3, 4, 5. Yeah. So this is the expected shortfall, and this is the negative VaR, because we are just looking for the numbers here. So and if we have to run the same things with weights, then we have this exponential thingy here. So it's like the EVMA, that we have the time index here, and that's why we start to reduce the importance by defining this weight. So it's higher and higher as we are closing up to the present day. So we can see that, yeah, it's much better. And after that we can weight them, because practically in this case it will be relevant for us what is happening recently. So then we have the recalibrated version of the weighted losses, because the threshold must be decreasing, so it's less than, yeah, so we can see that this is the possible loss. So if you are just right now, this is also in US dollars, or I don't know what, but so it's some kind of currency, because portfolio value is 1 and it's multiplied. So if you just increase it to 100, then now it's not able to interact because this part is separated, but in other cases we would be able to see this. And so the same calculation is happening here as well. And so if we are taking, or we have a lot of time to checking the parameters for the different uh, distributions, for different distributions for the data, so like a Pareto distribution, so which is flat-tailed, then we could see that practically this is the normal distribution VaR and this is the Pareto VaR. So we can have higher losses in this case. So that's why it's highly important. Yeah, but now let's see MATLAB. So what do we have? 8 week? Yes. VaR and expected shortfall, so clear. This is the wrong data set. Let's load this one. It doesn't matter that we have further sheets because the first one is always preferred by MATLAB, so yep. And after that we just select so this is DAX index, this is the Italian index, and this is the Spanish one. So 1, 3, 4. Okay, we have a smaller set of data set, and after that let's see that how can we calibrate a VaR model. So the most simple thing is to define the what is the thresholds. Oh, before defining the thresholds, let's estimate already a Gauge model on it. So let's see that. And let's be lazy and let's fit immediately a DCC Gauge model, because if we later on, if we need any kind of correlation, we need the DCC. So data small, so we need the logarithmic returns. Hopefully it will not fail. Okay. Just if we need so if we need just the variances, then we need the diagonal. Still, this is in the preparational phase, just you can say that. Conditional STD, so still we have to square root it as QRT. And then we have everything ready until this thing is not working. Yeah. So I have to put it in the for cycle in this case. For I equals 1, 2, and return. So for each day we have to check it because it's not able to deal with three-dimensional objects. I don't know why, but I for each day. Now, lang. Okay, it's not able to deal with my typos. But now it's good. So as you can see, these are the beautiful. And hopefully this is changing in time. Yes, it's nicely changing in time. So we can see that. And also this is not the same data, so sometimes we can see it's changing in a different way, so we are able to measure or capture the standard deviation. So now we can have the VaR. Okay, so for each days, VaR, let's say positive and let's say negative values. Let's define them. Different level, and let's define the p-value 0.1, sorry, 0.01, so 1%. So we can have, yeah, and for each day. So, and also for each assets, we need to distinguish amongst them. So we need a secondary for cycle. We find that we have 3 different assets, so 3 different VaR levels will be necessary. Or we can combine them in a portfolio, but at first I would like to show you the individual things, and then we can play with them or combine them together. So, okay, expected value, so mean of the return of the actual column. This is general, and this will be high, this 0. Yeah, so we could actually exclude this, but yeah, we are not doing it. Okay, and after that, if it would be just the 5% or 1%, so we could write here 1.65 or 2.326. That would be a simple case, but we are looking for some harder things, so we need the inverted normal distribution. Yeah, this is what I'm looking for. And yeah, so this is where we can mess it up. So this mu and sigma should be standard normal distribution. Once I was playing with that, and it was not the brightest idea. So we have to be careful about that one. Okay, so now So we can see that yes, but in this case if it's 1% then this should be negative because this is positive. Or we can say, because otherwise it will look so stupid, that 1 minus p, and in this case the plus minus will be in the right place. So now it's positive and now this will be negative. Yeah. And multiplying the standard deviation, which we know from here. So this is the elegant approach, because here we can see the time variant changing nature of the expected, the value at risk. For positive values, and this is for the negative values. So in many cases nowadays people are using, so even if we are saying that normal distribution is much more romantic and this is not a real thing, but if you are adding a gauge model to it, then it's so robust that practically you can work with this one as well. So VaR gauge. Several years ago I was talking with some people from Morgan Stanley, and also they were verifying it that they are still using it. So just add the gauge part and after that it will be happy. Then let's see expected shortfall. Because we know that okay, so before we are doing it, first of all I have to create also a portfolio for all of these things, because so this is the B, this is the A. And, yeah, so practically we can do this. That way, if you are taking the correlations between them, or just we have to multiply them on them together, and then we will happily living happily after. So wait, 1, 2, 3, and then portfolio return equals and I think it would be terrible if I'm just summing it up. So let's define the direction of the sum, because it's better to be controlled that way. I think that some function has also some directional choice, so we can so we could define it, but okay, until this is running happily. No, not that one. Until then, I'm looking for some gauge model. Okay, that was not efficient. So we are looking for the touch function. Maybe I should save this one. It doesn't want to run anything until it's not finished with the... Okay, now it's finished. Otherwise you can open it in a notepad editor, so... And also you can define here the error type, so we could say... Okay, I will show you this trick as well. So, if we can say that what is the portfolio return here, and if we are running the applications distribution filter, so data, period, yeah, do it, close, and then we are saying that okay, it's not a normal distributed data because it's clever. So let's fit some. Okay, we have only stable distribution, so apply. And we can say that it describes it in a nice way. So it is fitting much better or reliable than the normal distribution. Then we can say that okay, what kind of error type can we have here? Also, it knows student t distribution. So after that, we can say that yeah, let's use the brutal one. So 1, 1, 1. So we can tune this further, and we can build in the fattailness functions here, and after that we can say I would use this one. Just let's put P before the VaR as well. No, this one as well. And what is your name? Just HD. Yeah. And I have to remove this one to describe it to 1, 1, 1, 1, 1. So after some small modifications, then we can have the VaR normal values and positive or negative values and positive values as well. So we can see what is happening here. And if we would combine them together with the correlation between the data sets, then just we have to sum it this way, that way, so I can understand this works, just let's not do this. Because we need all the possible combinations, and until 3 assets it's seems to be easy, but after some levels then it will be harder and harder, so don't want to. Okay, so portfolio, we have it. So now expected shortfall. But before doing expected shortfall for a portfolio, let's check because we have many examples until we are reaching the expected shortfall. So let's see the book. So maybe I will and this is not. So there is a difference. So if the A is small, then it's value at risk. If it's big, then vector autoregression. If everything is small, then variance. So this is highly sophisticated. Okay, so calculation of VaR. And last thing, I nearly forgotten. One more thing, and this is I don't want to remove this point here because do we have anything for value at risk as a function? Value at risk estimation and backtesting. So we can have normal distribution, we can have historical simulation, and we can have exponential moving average EVMA approach. Yeah, okay, don't care about that part. Yes, we are going the same confidence intervals. Why is scoring z-score? Because z-score is standardization, and it just provides us the thresholds. So this is what we did here, and this is just for data management, because it just fills the right amount of data points with zeros, so it doesn't matter. It's not relevant for us. But at least it's nice because even if it's not using a Garch model, so it's less sophisticated than our approach, still it's calibrating the standard deviation for the estimation window. Just you can do it easier. And this is just focusing on the negative side. Oh. And also, yes, this is not recognizing that, okay, that's why they should focus on the negative values, because otherwise it would be positive, so that's why there is a negative value. That's why we used 1 minus p. In this case, there is no such biases, what we can see here. And they're just multiplying with sigma, so practically they don't care about the expected values. Okay, and at the end of the day, they have similar slow changing VaR levels. While ours are way superior because, okay, this is a negative value, so we can see that, yeah, this is how it should look like. If we are calibrating the standard deviation in the right way, this is where we are just using these rolling windows, because okay. Ooh. Yeah, window calibration. It's even more disgusting. What the funny part here is that now it doesn't care about the distribution. It says that, okay, the quantile will be determined here. So we don't care about that, what is the underlying distribution. Let's just take it to different quantiles, and after that the designated 5% quantile, 1% quantile will be relevant for us. So we can do it also in our own script. See. Personally, I'm using this approach not in the case of value at risk, but in the case of an extreme value detection. Because we don't have normal distributed data, we have some kind of fat tailness, but it's changing from side to side, so it's not even symmetrical, and it's changing from variable to variable, so I don't want to fit specific distributions for each time, so that's why it's simpler to say that quantile as a function. No, if I'm pressing this, it will override the other one, so it's quantile, but here we have to define the return in the thingy. So this is the data vector, and this is the designated quantile. Just if we are keeping it this way, yeah, so it will be not negative, so secure this. And also we can see that now we don't need the sigma at all, because this sigma is coming from the normal distribution. Here the quantile is coming directly from the data from itself. So if you don't want to fit large model, then this is the way. And that's why we can also eliminate this part. The historical simulation method. Let's write it here. So. Yeah, no, I cannot put it here. Yeah. Come on. Yeah, now it's a flat line. Yeah, so because I'm not allowed to change it. So, okay, rolling window. Here it works better because my rolling window was the Garch model which was changing in the background. Currently I can create just one constant value, so so practically I can set it to 1 and that's all. Yeah, because still we need some kind of subset, so we are not able to say that for each I numbers we can run this. What is the required mass of numbers? Test window start. Okay, so how it was defined? And estimation window size 250, which is practically a year in the trading days. But we just have we have a lot of days. So okay, then so T equals 140. This year, so we can eliminate or emulate something like this, because if we are saying that return I and I plus T, then in this case we have the similar calibration just at the end of the thing, so we are not able to run further. So in this case we just and quantile. So what happens if we are comparing them? They are not at the same length, so I cannot compare them easily. Yeah, but now we have similar things. So because of the rolling window nature, we have stuff like this. So okay, this was negative. Things are happening similarly in both cases, so we can see that yeah, this one is decreasing, this one is decreasing. Just the changes in this one is much smoother. So all these sudden peaks are obviously it's not so reactive to change that way. But we can see that okay, this one is decreasing. We can see it also. This decrease is visible here. Also, these peaks are happening here. Maybe this one is happening here as well. So we can see that they are related to each other at some levels. Yeah, this is the EFMA thingy. So exponential moving average approach. What I showed you last week. And yeah. So last week, whole last week can be captured in this single line, because here we can see that, yeah, so returns from the previous days can be relevant with 1 minus lambda, and also lambda multiplied by the sigma from the previous days, and after that we can add them together. This one is much more sophisticated again, because EFMA was developed before the Gauss models, or around similar times, but now it's yeah, and backtesting will be later on. So now let's see that what can we have in the case of VaR calculations. From the book. Okay, so calculation of VaR. Suppose that we have a portfolio. Let's comment them. During 5 months is normally distributed. Okay, so 5 months T equals, and also we need here t equals 0.5 here. Then with a mean of 2 million, so mean million USD and the standard deviation of much more USD. So what is the VaR? And here we can see, yeah, so just looking for the threshold because so 1 percentile, it's kinda necessary, so p equal 1. So then we just have to calculate this thing, so 1 will be given by mean let's do it nicely, so at least let's give the and it doesn't need any further. What? Yeah. Multiplying, yes. Minus. So this is what we can lose at 1% of probability. We don't know what can be lost later, but this is the thing what we can lose here. So practically this information is absolutely not considered in this kind of solution, which is not so precise because where are you? Yeah. So if we would like to convert it back and forth between a daily data set, then we could use also the square root of time. So later there will be a problem like that one, just not here. Okay, calculation of VaR 2. How can we do this? Let's say that this is 1, this is 2, because in this case at least it's connected to the book. Let's separate them with the space. If I'm writing here a line, a flat line, then also the script stops here, so maybe this is the most elegant solution. Create barriers between the different parts. Okay, let's comment them. So 1 year project outcomes between a loss of 50 million US dollars and a gain of 50 million US dollars are considered equally likely, so practically this is a symmetrical distribution. In this case, the loss from a project has a uniform distribution extending from within this range. But this uniform distribution means that the probabilities are always the same, which is quite stupid. And there is a 1% chance that there will be a loss greater than 49 million. So if there is 1% chance that there will be a loss greater than 49 million, if they are completely flat, and there is 1% chance that it means that, yeah, the VaR is this 49 million. So it's a no-brainer. So let's have calculation for VaR 3. Third one. At least these ones are still, this is not a normal distribution, so we can see that there is a really high chance to suffer 2 million in losses, and also there is a higher, sorry, really small chance to suffer even more, and there is a really small chance to suffer 10 million. So what is the confidence or probable loss here? And practically graphically we can see that, okay, if the confidence level is 99%, so we are allowing 1% of probable losses, then 4 million. Yeah, here we have some kind of calculations at least. So, coherent risk measures. Suppose each of two independent projects has a probability of 2% for a loss of 10 million and a probability of 98% of loss of 1 million. The 1 year, 97.5% VaR for each project is 1 million. When the projects are put in the same portfolio, probability of the loss will be something. Obviously, they are not talking about anything, so hopefully half. And this is the funny part. So projects are put in the same portfolio, so it means that we have 2% probability of failure here. Other 2% of probability of failure here, so altogether there is a really small probability of loss for the whole 20 million. So because of portfolio effects, we can see that this is not the case. But we have two cases when loss and non-loss or small loss scenario will happen. So this is the probability for the 11 million. And there is the good option where we have these two things together. So it's still 96% of probability that there will be a 2 million loss. So that's why the threshold here is bigger than this one. So that's why we are going to this region. Because if you are adding them together, then it's between it's higher than this number and lower or higher than this number as well. So it's 99-ish%. Yeah, so that's why we can say that, oh, it will be in the 11 million range. The total VaR of the projects considered separately is 2 million. Yes, because we are in this range. The VaR of the portfolio will be greater than the sum of the VaRs of the projects by 9 million. Yes, because it's 11 million, so 11 minus 2 is 9. So. And yeah. But now something that we can work with the MATLAB or parameters. This is second. Suppose there is a loss in the portfolio over a 10-day horizon. Its nominal between 0 and standard deviation of 20. So first here, then VaR. Well, we could take the same thing here, so then divided by here, mean is 0, standard deviation is 20, okay, it's 1%, yeah, this is the loss, and still we don't care about time, so this is just decoration. And now, finally, we have the expected shortfall. This is what I was looking for. Yeah. Parameters. Yeah, there is also a typo, but third. So ES parameters, so we can see the same amount of data is given to us, and that's why I did not like what was written in the, or how the equation is described, because practically this is the threshold here, and why it's epsilon? It's still the inverted normal distribution with the adequate calibration, so let's make it nice. So we have this data here, so let's say ES flatline 1. So we have the mean, and then minus the standard deviation, then multiplied with a huge number, so there is a division. This is much better or efficient to calibrate this way, because at least we can see that what happens before and after. Okay, let's define the under part. So there's a square root of 2p pi. Do we have a pi function? Yeah, we have. Okay, so we don't need it. We just have to take the p, the probability of default, because here it's calibrated like 99%, but it's already in the appropriate direction. And then we just have to define the upper part. So in this, no, exp, yes. So we have exp minus, again a bracket, and then there is a division mark. Under the mark there is 2, above the mark there is the normal inverted thingy. So hopefully no. No. Yeah. Oh. Yes, it's on squares. This one. Now it's good. Okay. So, if we already need this, ES for one asset, then practically these are all the components. So we need the mean to define, we need the standard deviation to be defined, and we have the probability to be defined, and nothing further. So if we are reloading everything, okay, I'm running this one, but it's quite useless, so let's run also that one. Yes, so I'm running also with all the necessary other components, and so after that we just take, okay, what was the mean period, the standard deviation was coming from the square root of the HT, v is 0.01, yeah. Okay, the mean is constant, but the standard deviation is not, so we need a force cycle. No, the force cycle is okay. We don't need it because it's happening also on partial level. We can do this because nothing else is changing, so there is no danger for matrix multiplication or other thing like this. So this is where we can see the extractive shortfall, and these lines should be bigger than these lines, because we can see that what happens after. Yeah, these are bigger just. Photoshop is. Here at this class we are using really precise methods, like fitting things with our hands. So great. Now it's closed, this one is also closed, so now we can see that these lines are, this one is definitely longer, this one is also longer, this one is way longer. So practically, this is how I can show you that, okay, if we are assuming all the possible losses after the designate or define the value at risk level, then this is why expected shortfall can be much better or much more efficient. So this is a nice example, but this one is not VaR parameters, this is ES parameters, but okay. Oh no. Yeah, okay, sometimes we have to watch problems like this one. So let's go back and autocorrelation. So in the Gauch model, practically, Gauch model means that generalized autocorrelation and heteroscedasticity. So practically, it gives us information about or deals with the problem of autocorrelation, at least because it's changing in time and it remembers. So we could say that this is not a big problem for us, but let's see the problem first of all. Thanks. Oh, could you close the door, please? So daily changes in the portfolio value are normally distributed. Cool, with the mean 0. Okay, that's first of all being in the clear. Then mean equals 0. Standard deviation is some millions. First order autocorrelation for daily changes is 0.1. It's a correlation, so how could we estimate this? Just let's check the real time or real life data. So if we are going for all the what is period? And we are just checking the correlation between it should start at time 2 because otherwise it will be failing. So I minus 1 and I 1. Why none? It's a valid number. This one is. Yeah, because I need intervals. Yeah, sorry. So. I minus 10. Still disgusting, but oh yeah, and it's now it's 10, so it should be 12. But can you work with this one? Why not? 10, 2. Why it's not able to deal with this? It's supposed to be. Okay, just calculating backwards. So okay, let's say that. Okay, now it's able to comprehend. Then okay, it was just indexing error. Ah, now we have data. So practically we need something like this. It's ugly, they are overlapping, just I'm trying to show you that okay, if we need if we have to estimate this autocorrelation with a correlation value, not just is there or not there, test by like what we can get with the Umbox test or the other econometric tests, then this can be appropriate. Just now we have to wait for the results because it should run 5,000 times. So, yeah, until so we can say that okay, we had this magical number, what we cannot have here, so it's always negative, and it is quite poor or quite weak. Standard deviation for the change in the portfolio over 5 days. So standard deviation for 5 days equals, we have no idea. So here in this case we should define the change in the price. We have to go back because we need 5 days, so that's why we have to go back for 5 time periods as well. At least it's not 20 because that would be long. And okay. No, not some main. At least autocorrelation is a number. Why mean is not working with? Doesn't matter its mode or whatever. Yeah, because I defined the mean and that's why the function mean is not working. So okay, so the median is still negative, and practically we have the same number, just positive, and this one is negative. So just for fun, if you need something like this, you can do it that way. And practically the delta p is supposed to be a return, but okay, so delta p equals the standard deviation. The standard deviation is, I think it's on the whole data set or on the whole sample, so you can say that. We would like to recalibrate this by using the underlying information coming from the autocorrelation. So we have a few square roots, everything under the hood, and then days. Days just backwards. So 5, not multiplied, everything is in 2 times. So, and t minus 1 Can we make this faster? Equals 1. So this one is, sorry, not equals 5. T minus 1 multiplied with this autocorrelation. Ooh, why so? Okay. Autocorrelation. AC. Just otherwise it will be so big. So yeah. And still we can also make this more efficient. T minus 4. 1. Yeah, I know you don't know, but I know. So and AC is 0.1. So just let's check it. That is this working well? It's working well. Okay, then we can just scale this thing up. Actually, we could write a nice for cycle for everything, but and after that just add them together. But this one is growing, this one is decreasing. And then, no, points. This one is now 4, this one is now 1. Hopefully I'm running out of things, yes. Why are so many data points? Okay. Now it's good. Then it's not containing information from previous calculations. And then we have to make this beauty here as well. Okay, let's start with the VaR. It's easier. But practically this is the standard deviation, because this is behaving like a standard deviation. So this is not, yeah, because this is some p data. This is really ugly. So okay, and then we just have to fit the VaR and ES on the data. Everything is in 5. Mean, okay, standard deviation, okay, norm mean, okay, P is non-defined. Not even, not defined anywhere, but this is 5% because I can see it from the numbers. 0.05. And now we're supposed to have mean 0. Still not that one. Yeah, because I'm using the wrong number. Yeah, so standard deviation flatline 5 must be. So we have to adapt the rest of the. Now it's good. And the ES, okay, so the standard deviation was updated here. The rest doesn't contain any kind of things, so can we do this? Yes, it's good. So it's nice because now we can convert for 5 days up. So what happens with the VaR for 5 years, expected shortfall for 5 years as well. Installation. And VaR and ES. Just in case we can see what we were doing. Okay, then let's convert from 95% of confidence interval to 99% confidence intervals. So practically this is not autocorrelation, this is time conversion. And this will be confidence interval conversion. Okay, suppose that the 1 day VaR with confidence level of 3 is, yeah, so 1 day. We are keeping this fixed. Then, next thing. VaR equals I'm still preferring the other description, 1.5. Yes, I hope so. It's still 5%. Let's do. Using the assumption that the distribution changes if the portfolio values is normal. Yes, and the mean 0. And 1 day VaR and ES will be looking for this one and also this one. Okay, and 5 equals 5 and P1 equals 1. I cannot add old, new or something like this, so this seems to be maybe the most efficient way, but yeah, from coding point of view, this is not nice. But anyway, we can say that, okay, we can convert this thing here, multiplied with the relationship between the two normal inverted p-values, just the old one with the new one. So let's, or original, new, or something like this we could add, but this requires lower amount of characters. And it's much efficient if I'm using the and the right amount of decimals. What? Oh, I'm doing this in the opposite way. If there is a slight chance to make a mistake, I can do this. Okay, then expected shortfall. Someone hates us. So we have to. Obviously, we are not typing this whole thing in. So let's start to work nicely. So we can see that we don't care about the mean. We can remove this. Also, the standard deviation is irrelevant for us, so it's already in the equation. Then what remains for us is the normal inversion and these things. So, and we have to build up the relationship because in the past this was on squares, but now we just have to define the difference between the two components. So it's like running interpolation, maybe the mathematical equivalent. So we are removing the squares because it's not with itself anymore, but and big number minus small number. So this one is the big number. Which is counterintuitively the 1. And this is the small number because it's smaller. Yes. And also, just I'm checking that the brackets are in the right place. Yes. Multiplied with this same thing plus, and then point. And also we should not forget that under here there should be the u1. So this is where yeah, because this component, the 1 minus p. Okay, before the exp we should do the multiplication with the. But for us this is just the old p. Yes. Okay. Not even close. Okay, so let's check that. Okay, but this is multiplication, so it's good. So this part of the bracket is okay, this part of the bracket supposed to be okay. This is containing the whole multiplication. No. This thing is containing the whole multiplication and the division by 2. Yes. This one is on the top of the Euler number. There is some kind of, yeah. We have more brackets or less brackets, but something is excessive in nature. Okay, then we have the exp. But then where this bracket is also not necessary. because still we are on the top. But in this case, it doesn't matter because we are multiplying something and dividing, so it doesn't matter that while this is happening. But I don't want to mess it up, so why are you thinking then? Okay, just checking that I'm following the right order. The daily debugging game. And then this is added, then this is multiplied. Sorry?
It's divided by the square root. Is it the same?
Yeah, it is the same. There is the
Oh,
multiplied by p1. Oh, 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 yes, this is absolutely not necessary, yes. Yes. No. Still not good. Yeah, but now this is also half. Maybe it would be much more efficient if I'm writing it instead of zero, half. We could practically divide this one with this one and after that multiply it with these numbers here. The result would be completely the same. So why we are not doing it? Instead of using multiple completely useless brackets. Yeah. Yes. Just I cannot see. Where is it located? So I start to eliminate the brackets. And we don't need the dots anymore. Minus, plus, divided by 2. But why it's half the size?
yeah, it's 2 times 0, 0, 5, which we don't have a 2 times. By 2.
Oh!
Yes.
Yep. Hey! Close enough, yes. Yeah, I will be happy with that. So. Because we have to calibrate this only once and after that it will be absolutely efficient. So aggregated expected shortfall. Suppose expected shortfall is calculated for 2 segments. There is a business which is where it's 60 million and for another business is 100 million. The correlation between the losses is estimated 0.4%. It's not percent, it's correlation, so 0.4, and the estimate of the total ES is something like this. So ES for a portfolio. So practically, we just have to build up the. So this is that's why I did not like this kind of description, because practically it looks like as a portfolio, but not with the standard deviation of the portfolio, but with the expected shortfall of the portfolio. So the mathematics are completely the same. And we also, so the weights also coming with the analog of the standard deviation of the portfolio. So we don't have the weights at all because they are already the weights. So ESP equals square root of ES A on squares plus, let's put it in the brackets because it helps. What? Plus. So we have to construct something like this. $160, 0.4. Okay, I mixed them up, but it doesn't matter because it's symmetric. And then, yeah. It's good at the first time. If you just add them together, it's behaving in the appropriate way. So this is where, should we reject the model or not? So are we inside the confidence interval or not? And okay, this is calibrated for Excel. So let's see how can we do this in MATLAB. So backtesting. Next week, practically we will work a lot with backtesting. So this is the introduction just for the next week's. No, next week there will be the epic football play against the lawyers. Last semester we were setting up a team against the lawyer professors with really professional. So we had everybody was really good in our team, just we were not able to play as a team, and we were. I think we get a lot of goals, but it was um, like we were able to have scored 2 and we got 9 or something like this. So we were destroyed literally. At the beginning, oh, they are old people. Who cares? Who cares? And after that, I was a goalkeeper, and sooner or later I realized that yeah, age doesn't matter. At some level, if you are not able to compensate with experience and technology. Okay, so we need binomial distribution. Nothing. This one. Is this thing? Binom dist. One thing, another thing, and it's true. Number of trials, probability of success. Let's use it, we will. But I don't need an object. I need... for backtesting. But I just need the... Oh, come on. Objects here and there. Eh. Binomial test. Yeah, I need this. I need this. Can we do this manually? For each days. Okay, that would be... Mm. Practically, I'm looking for the test or the function which is running behind. And we can trace it back with a simple approach. Okay, so we have mm, mm, Okay, let's see that how does it look like. It contains a lot of things, and now it's completely mixed with mine. So let's clear this up and let's see again. Okay, so we have all the components. We have to organize them. Yes, now it's happy. So this is what we can see in the example, that we have 600 days of data, so these are the observation numbers. And this is the number of failures. It doesn't give us the number of when, so which one is the practical exam or exception. I think that the failure should be, because this is when we are missing, but this is not given, so it's they don't care about that one. What we can see here, that at the end of the day, so it gives us a test result. So this is the p-value, and the p-value being so if it's under 0.05, then it will be rejected. So the reject the model is yes. If we are under, here we should not reject the model, but it can be nice, because if we are checking the equity index, so this is the return here in the data, and the EVMA will be this. Which could be updated. So if we are start to dig in, and we can reconstruct it with Gauge as well. So this is also the historical. We had also historical, so we can replace most of these variables. What is this normal? Yeah, we did. Okay. So we can replace 3 different things with 6 different conf intervals, but I think that we can also reduce this. So if we are removing or eliminating this part of the data and this part of the data, then we can simplify things together, or calibrate them nicely, and after that we can just test it. So let's do it. Okay, I'm not making the same mistake again. And then this is the next thing. What? We have also historical simulation. Okay, now we have the historical simulation. And here, this is not a clear anymore. So let's remove this one. Let's put into command. And hardware test. Equity index will be the read. Sorry, read. Normal 95 is VaR and we can also check the historical because we have this as well. So VaR and Q. We don't care about the rest. Portfolio ID, equity, VaR ID, normal 99, and historical 99. The rest is not necessary. VaR level, it's only on 99. I think that we should also give it here because the right amount of variables require the right amount of conf interval. And then, what is this? Yeah, test level. So it's supposed to be, it's not 90, it's 95. Yes. Oh, yes, the poor thing. Okay, I'm trying to add. Okay, I have to limit the size of my data set, so it starts later, or yes, it starts later. So it's yeah. Now can you combine them? No, still not. Then bigger number or smaller number. So now, so it's oh come on. Okay, we can deal with this. But why is this only one? Ooh. Yeah, this is another problem. Okay, so we have two issues right now because one is not weighted and the other is not the appropriate length. So VaR small. And the other thing is that this is not a portfolio. Yeah. Okay. dimension. Okay. Cool. And then just divide it with 3, and after that it will sum it up. Okay. And if I'm cutting this in the right structure, if I can put them in a plot, VaR and something, and the other is too big. 8. Oh, it's even bigger. 6. Yes, they are the same size. So, okay, now we can first of all highlight differences between. Oh, these differences are quite significant. So we can see that this is ugly, this is less ugly. There was some unnecessary graphics. Same number of rows. That I'm using the same number of. Oh, not using the same number of rows because this ret is also. Now I'm using the same amount of rows. And he rejected it. Yeah, not able to use them, any of them, for calibration. So, good job. Taylor's observations